Okay, there we go. Now, let's get started. All right. We're going to cover the following topics. We're going to cover what goal setting is like and how you should go about thinking about the goals that you want to set. We're going to talk about basic budgeting. We're going to talk about creating an emergency fund, really important. We're going to talk about, in brief, insurance. I know it's not everybody's favorite subject. Using credit, using it wisely. Investing, kind of the bridge to get you between where you are now and where you want to be for the retirement plan. Some tax planning. There are a lot of different outcomes that tax consideration can help you achieve. And savings for college, we'll cover that briefly. It's a goal for a lot of people, but not everybody. Some retirement planning, that's there for just about everybody, so we'll spend a little bit more time there. And estate planning, as far as how, again, to kind of protect your assets, to move them to the people that you care about, and all of that good stuff. So setting your goals, you need to kind of think through what you want to accomplish with your life, as far as your financial future. Maybe it's just paying down debt right now. Maybe it's saving up for a new car, new house, college savings for your kids, or vacations, toys, all of that good stuff. Retirement is definitely something that factors in as well, but you can also look at all sorts of smaller goals. You need to have the SMART goals. So what is SMART? Specific, measurable, attainable, relevant, and timely. So for a specific goal, for instance, you want to say, instead of I want to retire early, maybe I want to retire at the age of 63, 65, 45, whatever it may be for you. Measurable, you're going to have maybe a sense of what, what your income is now. You might know roughly what you want to be able to retire on. Kind of a general rule of thumb is maybe about 80% of your income is combined income. Maybe if you're a family, is what you want to kind of have as a target for your annual retirement. So you want to kind of define what that may look like for you. Something that's attainable. Trying to save up $1 million in 5 years is going to be difficult for most people. Not everybody, but most people. But maybe saving up, $1 million over the course of 30, 40 years, that's maybe more achievable. So, make sure it's possible. Relevant, something that's important to you. It doesn't, again, if you don't have children, you're not worried about financial college savings. And it might be something small for you. Maybe you just want to save up to do a nice vacation in about 3 years. But think through what you want to do and make it personal. And then timely, you need to be able to specify when you want to do it. Retirement at this age, I want to buy a house at this age, because that's really important to create the time horizon for it. And the longer that you have, maybe the more risk that you can take in the investing that's going to get you there. If it's a shorter time period, you're going to be kind of going off what you have as liquid assets, and you want to make sure that you're protecting that if it's a short-term goal. Write them down, prioritize them. They're kind of 3 different buckets of needs, want, wishes. So if you think about the sort of stuff you absolutely need to plan for retirement, wishes, maybe it's a vacation, maybe it's a new car. Yours, is still working, but you're thinking about replacing it before long. So prioritizing them will help out as well to say, maybe that's not attainable right now. Maybe we need to push that one back a little bit, another year or two, or maybe it just doesn't make sense to do right now. So be kind of honest with yourself as far as what you want to get out of the financial planning. Okay, budgeting. Budgeting is taking a look at basically your cash flow. So everything that you have coming in from your paycheck, maybe you have some rental income, maybe you have some benefits that are coming your way from government, any interest, that you get, as well as your investment income. And then you're going to subtract from that your fixed expenses, your rent and or mortgage, any of those utilities, etc. If I've gone through this exercise, and it's amazing how many expenses we have that are now on auto pay that you're not necessarily even remembering or noticing. The different streaming services, some of the utilities maybe on there. Probably at this point, you have a lot of your fixed expenses on auto pay. So I've got worksheets. If you're wanting to do budgeting, let me know. I can send them to you. It's there are a lot of prompts on it, and you may or may not have those all, but you probably have forgotten about some of your expenses that show up every 6 months or quarterly, maybe even some of the smaller ones that are showing up monthly, that unless you're checking your credit card or something, you may not even be seeing. So you take that income, you subtract the expenses, and you get your cash flow, and hopefully it's a positive cash flow. If it's not, you've got to take a look at either trying to figure out how to increase your income, obviously, or decreasing your expenses. That one's usually easier. And if it's positive, then you should start putting some away towards an emergency fund. An emergency fund ideally is going to be maybe 3 to 6 months of expenses, not income per se, but expenses, just to make sure if something were to happen, you got hurt, you lost your job, another pandemic, any number of different things that could happen. You want to have it safely set aside. You want to have it in a way that you can access it easily. So probably checking your savings. You don't want to tie it up in investments, especially something that's risky, because it might not be there when you need it. If everything is feeling a little bit scary out there and the market's responding as such, you might lose a lot of that emergency fund. So just keep it in cash. And, depending again on, are we in just a regular environment? Maybe 3 months is good enough. Is it starting to feel a little weird out there or other things going on? Then maybe you want to increase it to 6 months. Insurance is a big factor for financial planning. This is a way to mitigate a lot of risks. And by risks, I mean, the risk that it's going to cost you a lot more unexpected surprises than you were anticipating. And that can take a big chunk maybe out of what your retirement savings were and can kind of derail your plan. So take a look at the different kinds of insurance. We'll go through each of these in a little bit more detail. Health insurance obviously is a big part of it. It's amazing how much even minor procedures cost. If you've got to go into the hospital and stay a night, you're looking at a huge bill. So you've got to have health insurance. Hopefully you've got good health insurance. Take a look on the exchanges if that's where you have to go for it, or if your employer's covering it. Consider the different plan options and choose the one that's right for you and your family. Auto insurance, recently had to look at utilizing that ourselves. I won't name names, but my oldest daughter, who is on this call right now, bumped somebody's side view mirror. She scooted out of the way to avoid being clipped by an oncoming car. So we just had to kind of I had to go through the insurance program. I knew what my deductibles were and what my costs and coverage was, but to actually have them explain to me, this is how it's going to work. For instance, if the damage that had happened was greater than $1,000, I was going to be faced with basically paying them that $1,000 over the course of the next year when I renewed, and then another $1,000 the second and the third year after that. So insurance is important, but every now and then it doesn't necessarily work to your advantage, and you've probably had that experience. Life insurance, especially if you have, if you're single, this isn't a big deal. If you've got a family, this is really critical to take a look at. Ideally, if you've got a mortgage, you want to be able to have life insurance that's going to cover the cost of that, especially if you are a working spouse and your spouse is a stay-at-home spouse, doesn't have their own income. That could put a serious hazard in their way. And so they're going to need to potentially look to sell the house and those sorts of things. So take a look at your insurance and consider what coverages you might need. It doesn't have to be much if you're renting or any number of different things. As you get older, you might have fewer needs. There are different types of insurance. Obviously, term insurance is one of the cheapest ways to provide that kind of in that middle of life stage. It's like renting insurance. It's a very inexpensive monthly premium or annual premium, and you get a pretty good amount out of it. But after 5, 10, 15, 20 years, whatever it may be, whatever you signed up for, it's going to get a lot more expensive and you have to renegotiate and look for a different term. Property insurance, make sure that your home is covered for earthquake, fire, all that good stuff. If you live in Santa Barbara, you know that wildfires happen all the time and we got to worry about it. Liability insurance, in case somebody gets hurt on your property. Umbrella insurance, which is kind of a catch-all for a lot of different things. Important to consider, even if you're having a party at your house, you might want to consider just having for the day or for the evening, some temporary insurance to make sure if somebody has a slip and fall sort of situation or whatever may happen, that you've got additional coverage and nobody's coming after your personal assets. Disability insurance, if you are injured, can't work, especially if you're a physical, your job is physical, you really might not be able to do it at that point, and you even could be kind of out of a career. So disability insurance is a big consideration. And long-term care insurance. Long-term care, as the name implies, is for a greater than 60-day period where you can't do 2 out of the 7, I think, basic life functions, mobility, dressing yourself, those sorts of things. Long-term care insurance, there are a lot of different ways to do it. It used to be just like car insurance where you just kept paying into it, and if you never needed it, it was money that you spent and you don't get back. But there are more and more policies that allow you to pull back whatever premiums you paid if you decide you don't need it anymore or don't want it anymore. Men generally don't need a lot of long-term care. We just kind of die quickly, mostly. Women, because they live a lot longer than men, might be a better candidate for long-term care insurance. But especially as you're thinking about your family and your planning, it's a consideration. Using credit, obviously, we all need credit. You want to establish good credit. The 3 C's of credit are the capacity. When a potential borrower or loaner is looking at whether they're going to grant you credit and how much, they're going to look at your capacity to pay it back. They're going to look at your character. Have you been paying back credit regularly? They're going to take a look at credit reports. And some of them might, or depending on the loan, obviously might need collateral, something like a mortgage. It's kind of put up against your home. The creditors determine your credit worthiness. You fill out a credit application, you give them a lot of information. They're going to run a report on you. And they're also going to take a look at your credit score, which is affected by and large by how much revolving credit you have outstanding versus the capacity. The more credit you have is not necessarily a bad thing, but the more of it that you're using and aren't paying off every single month, that's going to be a big factor on lowering your credit score. Debt is funny, there's a really good reason sometimes to carry debt. Obviously, with a mortgage, with the home purchase, most people aren't able to pay it off right away. So you have to take on debt, student loan debt, things like that. Debt can also be very strategically used if you are getting a return that is going to be greater than the amount that you're paying for the debt. Then it makes sense to carry that debt. Using credit obviously is going to create your debt. You've got 2 types of debt. Basically, you've got secured debt, which is, again, where there is collateral against it, like a mortgage. And you've got unsecured debt, which is like a credit card, where there are no assets tied to your credit card, really. Some of the considerations, how much you take out it's payable at a certain fixed amount, and that amount gets larger and larger depending on how much you are borrowing. The term, credit cards obviously don't really have a term. You need to pay them something every single month, but you don't ever have to pay off your credit card. It gets expensive, obviously, but you don't have a specific term. Whereas a mortgage, if you got a fixed 30-year, you're done. All of that debt is paid off in that period of time. When interest rates are really low, like they have been for the last several years, if you have an opportunity to take something that is a kind of an open-ended variable line of credit, it's a really good idea to get it fixed. That rate, the amount that you pay to borrow, obviously with credit cards, sometimes that can be 18+%, and your mortgage, every single point counts. It's a significant savings because the amount is that big. Investing, we covered this slide the last seminar, which was investment basics. And it's kind of a cross between speculating because you're not sure exactly what the future is going to hold, and savings. You've got to combine, you've got to put some stuff aside now with the faith that it's going to be larger in the future than it is now, keeping up with inflation and all those things. So the general trends, of course, are the market tends to be up in longer periods of time. If you've got a time horizon that's 5 years, 10 years, the market's probably going to be up higher. Your specific stock selection may or may not, but if you broadly diversify, you should be in pretty good shape. Risk tolerance is a big consideration as far as your investing, as well as creating your financial plan. The more risk you take on, the more opportunity you have. In a longer term, this tends to work out. If you are approaching retirement, if you're approaching, one of your goals that you had, you really want to start taking risk off because you want a more predictable outcome. If the market goes crazy right before you needed that and you're down 20%, you're going to be really stressed, and it may be hard to make that up, especially if you are losing your source of primary income because you're retiring. Your personal tolerance for risk. This is, in the past, it's been really undefined. You're basically just qualifying yourself as I'm aggressive or I'm moderate or I'm conservative, and those mean different things to different people. I would encourage you to just, for the exercise alone, come to my website, which is zenwcs.com. I'm going to bring that up real fast. I got the St. Patrick's Day colors going on. If you scroll down a little bit, you're going to come to the beginning of the text on my opening page. Right here, this button that says Free Portfolio Risk Analysis, that's going to launch you into a questionnaire. This questionnaire starts defining how much risk you're willing to take by giving you numbers and saying, over the next 6 months, are you willing to potentially put this kind of capital at risk, this dollar amount, to have the upside of this dollar amount? And it, really defines, this will get you down to a specific number between 1 and 99. That is your risk. And then the next step, if you're interested, is we take a look at the portfolio and we say, this is the exact risk number between 1 and 99 in your portfolio. And if those two numbers are far apart, then it's worth having the conversation about how do we get them closer in line with each other. So it's free. I get notified when you fill it out, and it gives me, at least your email address. I can follow up with you if you have any further questions. Back to the presentation. And that second part of it, really defining, after you defined your personal risk, how much risk is inherent in your portfolio. And this will be by the position. Each position that you have will have a historical known risk number associated with it, and the program will kind of aggregate all of these. So it's a very, very specific. There's usually a trade-off here between growth, income, and stability, and all of these are important considerations for your portfolio. This is something that I look at a lot when I'm constructing portfolios. You want to have some of it that's growth-oriented because you want to keep up with inflation. at least, if not surpass it. The greater the growth that a particular investment has, it's less likely to give you much income, and it's also probably a little bit less stable. If you have something that's more income focused, a CD, for instance, is very conservative and it doesn't give you much income. Corporate bonds, something like that, because you're getting income, you're not going to be getting a lot of growth from it. There's just not that much return, but they are going to be more stable. So this is kind of the art and the science of putting together a portfolio. And this is about, once you've defined your risk, matching it with your portfolio so that the outcome is something that you would expect. It's great when the market has a really strong run and you're up higher than you may have expected, higher than you may have otherwise been if your portfolio was appropriately matched to your risk. But when it goes down, you really feel it. And you want to try to avoid that downside because it's so difficult to work your way back up from a big loss. And it's also just, you want to pull out, you want to sell, you want to do all of these things that are a natural inclination, and it's the wrong time to do it. So you just kind of have to stick with it and trust the process, but it's hard. So make sure that your risk in your portfolio matches your personal risk. All right. Tax considerations are big. Your employer probably has some options for you to use some pre-tax dollars to pay for expenses. Pre-tax dollars are fantastic. Benefits are usually paid out of that. If you're in, for instance, your tax bracket is 22%, and you have to buy something that's $100, you're only paying $78 for it because it's pre-tax. You are paying less for it. It's whatever options you have to do pre-tax, you want to consider it. Except there are some of those sorts of accounts that your employer may offer you where you have to use it or lose it within the year. So pay attention to what you're signing up for and if you're able to keep it or not. And definitely, your 401k, that's a pre-tax contribution as well. And often employers have matches. You want to make sure that you're contributing at least enough to get their match with it. And then there's tax deferred growth, which you're going to be putting money aside. This is, an IRA. This is a 529. Some of these sorts of savings plans, they're going to be, a traditional IRA is pre-tax dollars. A Roth IRA is after-tax money. They grow tax deferred, so you're not paying taxes on them as you go along. It's not until you start pulling them out. And in some cases, with, for instance, 529s and Roth IRAs, it becomes a tax-free distribution if you're using it for, in the instance of 529s, approved college expenses. So it's a great way to get a little bit further along a savings plan than if you were to just do it with after-tax dollars. But a lot of these, there are penalties to pull money out early. So you want to diversify your tax kind of stashes as well. It's nice to have a 401k. It's nice to have an IRA, but think about also just having some taxable money that, again, your emergency fund needs to be free of any penalty for withdrawal. And whatever else you have is going to be what you're living on until you're able to pull those retirement assets or until you start using those 529, start getting those 529 expenses. This graph shows the difference between the same dollar amount over the same number of years with a 6% growth and a tax rate of 24% working against the taxable investment, the blue line. And you can just see tax deferred growth gets you a lot further. And even when you need to start pulling it out and getting taxed on it, you still have accumulated a much greater amount. And it's probably going to be worth it in the end. By the time you've had to make all your distributions and get taxed on it, it's probably still come out further ahead than the taxable investment. But again, because we don't know where tax rates are going, it's good to just have a little bit of both taxable and tax deferred. The 529 plans are a great way to save for college. You can make large contributions. Living in California, we don't have any tax breaks for investing in 529 plans. Some states do. There's also prepaid tuition plans that you can pay into. You've got a guaranteed outcome from it. And those are a little bit more rare and people don't utilize as often, but that's another option for saving for college as you're looking at how do I do this. 529 plans are a great way to go though. Grandparents can contribute, parents can contribute. They're run by different states. You have a very limited, usually like one fund company is going to run the plan for different states. And so you're stuck with whatever investments they have, but almost all of them are target-based plans. And they get more conservative as your child gets closer to college age so that they're more predictable, like we were discussing earlier. And that's the easiest way to go about doing it rather than trying to create your own portfolio. We had this slide as well last time. You want to start saving for retirement as soon as possible. If you haven't yet and you find yourself up there in the 30s and your 40s or your 50s, it's still not too late. You're not going to maybe have as high of an outcome as you otherwise would have, but it's never too late to start. If you're young though, now's a great time to start. Even just putting away a little bit, compound interest, it's gonna do well over the long run. Just put a little bit aside. It doesn't have to be big. You'll be surprised by how much it grows. Here's the different dollar amounts that you can end up with, whether you started at 20, 35, or 45 with $3,000 you're putting in every single month, annually, I'm sorry, and 6% return. So you can see just how great of a difference that is, the shorter you have to do it. When you're thinking about your retirement and what that looks like, there are a lot of different variations of it. Some people really kind of want to go big and be able to travel all over the world at the time. Some people just kind of want to stay at home. But you kind of have to think through what your retirement vision is, and that's really relevant to the planning. What kind of expenses you're going to have. The earlier you retire, obviously, the longer time period that your money needs to last. So, you know, some people do this with confidence. Social Security, though, isn't going to be available to you until at least age 62. And if you started right away, you're not going to get as much out of it as you will if you wait. So just, it's a big consideration. A financial planner or advisor can help you determine if that's what you have in mind is realistic. Certainly the software that almost all financial planning is done on will help. It's the software now is amazing. It can stress test all sorts of things. You can play with numbers, you can play with interest rates. It's great. So, you know, if you're not sure, software planning will, financial planning with the software will really help you determine what is affordable and what isn't. Yeah, 25 years or more in retirement. I mean, more than a quarter of your lifetime. It's a long time to not have to work. It sounds amazing, but it also requires a lot of planning, and you need to start up front to be able to pull that off. We've already kind of touched on this, that it's nice to have tax deferred savings vehicles to grow your money for retirement, because you're not paying taxes annually on it. You're going to see it grow a lot further because of that than if you had it in a taxable account. But you're going to need readily accessible, penalty-free money until you can start pulling things out of your retirement plan. So it's good to have both. Roth IRAs are fantastic. You know, even if there are phase outs for eligibility as you start earning a certain amount, but you can take what you have. If you've ever rolled over a 401k, if you've changed jobs, or if you have a traditional IRA, you can basically convert it to a Roth. You pay taxes on it now, but all of your growth, everything you pull out of a Roth is tax-free. So depending on your age, it might be worth considering converting your traditional IRA to a Roth or a portion of it. And that's another thing that your planner, your advisor can help you with. We've covered that 10% penalty plenty of times. Estate planning, this is a big part to think about. We're going to cover the intestacy rules briefly. Wills and trusts are critical, and planning for incapacity. If you die without a will, which is what intestacy means, the state is going to determine how your assets are divided. They vary from state to state, but it's probably not what you want. For instance, a lot of them will give half to your spouse and then the other half to however many children you have, evenly divided. You might not want money going to your kids just yet. Your wife, your spouse may need all of that to, depending on how old you may have been, to make it through the remainder of his or her life. So you really need to have a will. If you don't have one and something happens to you, the state rules come into play, and there's really nothing you can do about it. Like I said, your actual wishes are irrelevant. If you didn't put it down on paper and get it notarized, signed, go to an estate planning attorney, work on your will. A trust is a good consideration as well, but really important to have those. And that basically, your IRA, your retirement accounts, you have named beneficiaries, so that's going to go directly to them. But everything else that falls outside of that, that's where your will comes into play. Another thing that a will can't do is name an executor or a guardian for your minor children. I know it's really hard to think about passing away when you have young children and you're nowhere near that age where you're thinking about dying, but accidents happen, and it's something you should consider and plan for. Yeah, some of that wills and estate planning, you can do different things with them. Try to minimize some of your taxes if you have a really large estate, but mostly it's just to make sure that your needs are taken care of. And these need to be written properly and signed by you and witnessed, notarized, all that good stuff. So again, this is something that you do with an estate planning attorney. Don't do it online. Incapacity. I don't know about you, but I know a lot of people who at a young age had woken up in the morning. It was a perfectly normal day and something's happened. They had a stroke. They got in a car accident. These things can happen. So if you have not made that will, you're going to have somebody's going to have to come to your aid as a guardian, and they're going to have to keep going to the courts. Every time there's a decision that needs to be made, they're going to have to get the court's approval to make that decision on your behalf again. Whereas if you had the advanced healthcare directive stating that this person can take care of all my healthcare decisions if I'm incapacitated, then it's very easy for them to do it. So also wills, trusts, and the healthcare directive, something you want to come back and refresh every couple of years. Go meet with the estate planning attorney again and just go over them. In fact, actually, my wife and I had a trust drawn up that we signed off on that we thought was correctly dealing with everything the way we wanted to. And when we came back a couple of years later to just have it refreshed, basically, we learned that it had been written up unbeknownst to us in a way that we did not want. Basically, if I were to pass away, it would give half of everything to my wife, but the other half to the kids right away. And like with those intestacy rules, that's not what we wanted. I wanted it to go all to her, that she stayed in control of it, and then she was able to, at her discretion, pass anything out to the kids as they might need for college expenses or what have you. But we would have inadvertently signed up for them getting money, maybe at an age when they weren't ready to handle it yet. So even getting a will, I don't know how we missed that, to be honest. I thought it was pretty clear, but something happened and we did not notice it until the next person took a look at it. So keep an eye out for those sorts of things. So that's kind of that high level. That's a little bit of everything to consider when you are thinking about financial planning. Like I said, the software packages that are used now are really good. I mean, just they can stress test. They do the Monte Carlo analysis where it's going to do 10,000 different trials, because since we don't know what life's future has. It takes all sorts of variabilities into account. It's going to give you a probability of achieving your goals, any number of which you have stated. You know, retirement at age 55 with $120,000 a year, you know, purchasing a home in 6 years, that's going to cost this. You can get very granular with your wants, wishes, and needs, and it will take a look at the probabilities. It starts with the needs, then goes to the wants, and then goes to the wishes, and let you know if it's realistic or not. And you can start solving then for, if it wasn't enough, what can I do differently? And the system will help just determine, like, that, you know, you need to save $2,300 more a year, or whatever it may be. There are different tax savings that you can model out and see how much over the next 20 years that might save you. A lot of stuff that it can do. It also then just gets all of your assets and liabilities on one document and gives you the ability to, whenever life changes, whether it's within the same year, you know, you're expecting a new child and you want to add college expenses in 18 years. Your car breaks down and you want to double check, like, if I get a new one, am I throwing off the plan or not? You know, just coming back to the plan regularly. Life changes, the plan should change along with it. But it's once you have it done and completed and kind of all the assets and liabilities there, it's really easy to make changes to. So I encourage you, if you've ever thought about doing a financial plan, it sounds like a lot of work up front. And I mean, there is some, for sure. You've got to kind of get paperwork together. You've got to be able to explain what you have and what you want, and define for yourself what it is you want. And sometimes we go through life without really quantifying that. But once you do it, go through that exercise, it's really easy to make adjustments to it. So I'd encourage you to contact your advisor or financial planner. I'm of course happy to help you with any of that stuff if you want. But that's financial planning in a nutshell. So are there any questions out there? Go ahead and use the Q&A or give it a couple minutes. Everybody see, by the way, that tax filings have been pushed back to May 17th. So if you have been stressing about trying to get it in by April 15th, you just gained an extra month. All right, I'm not seeing any questions. Thank you all for spending your time with me. Happy Thursday. Have a great weekend. And in 2 weeks, we'll be doing estate planning basics. So we'll cover some of the wills and trusts in a little bit more detail. Thank you very much. And we will hope to see you again in 2 weeks. Bye.